Hello, guys. Good morning. This is going to serve as your 20.1 lecture for entrepreneurship, and this is all about accounting and financial reporting. Some of you have had accounting in the class, and this is going to be a review and a refresher. Some of you have not, and for you, it's going to be a little bit different. We're going to jump a lot into numbers and just the way it all works. This is a good lecture. I like it a lot. It's a lot of fun, so let's get going. All right, today we are focused on the important role accounting plays in a business, why it exists, why we do it, and then we're also going to tie in the reason for small businesses to actually use accounting systems, and then we're going to describe the critical importance of daily cash sales and daily cash receipt reports, and it's going to look a little bit like this. So this is a comparative balance sheet, and it brings in multiple years worth of information. And you can look at this and you can do some quick analysis. You can say from 2013 to 2016, well, the business has had more cash. Then their accounts receivable has gone up as well. Their inventory has increased also. These are all signs of an improving business. And then you can say, just by looking at this balance sheet, that, hey, between 2013 and 2014, there was some kind of purchase in assets. Now, this is one of the things I got to do at the bank, and this was a lot of fun. These are all the things you can tell from numbers, and we could keep going on this. We're gonna jump right into this lecture, but I wanted to open with what we're gonna be working on this week is this balance sheet. And in your notes on the last page is a comparison between the balance sheet and the income statement. To me, this is one of the most critical things in accounting. These are your two major financial statements, and it's what you're going to have to understand the difference of. So, as we're going along, and I remind you to write things down on that back sheet, make sure you do so. We're going to take lots of notes on what the two financial statements do and how they compare. All right, the heart of the matter. Business must record all financial activities using established procedures and processes. No one tells you exactly how to do your accounting, but there are a bunch of standardized assumptions and rules. We call them generally accepted accounting principles, which stands for GAAP. Along those same lines, having all this information consistent is because more than just you wants to know about that information. We also have the owners of the business, and we say owners just because you're an entrepreneur and you're the owner. You may have a lot of passive owners that just want to look at numbers but provide you with financing. They're part of the way businesses function as well. Banks. You may want a loan for a bank. A bank that sees poor financial accounting statements loses interest in working with that client very quickly. They want to know that so-and-so knows how to do proper accounting so that when they look at their numbers, they're accurate. And then investors goes along the lines of owners, but investors want to know, in order if they're going to make an investment decision, whether or not they should do that, and what they look at are financial statements. And then lastly, the government. Government wants their taxes, and they will always get it, but they definitely want to know that you know how to do your financial statements properly. Vocab for this chapter is quite a bit, and we're going to go through some, and some we're going to do a little bit later. But for right now, let's just keep going. Don't be overwhelmed by this vocab. We'll break it down over time. All right, why is understanding accounting important for a business? We just kind of talked about that. And then what can financial statements tell us about a business? So operations and the day-to-day activities of your business is maintaining accurate, up-to-date financial records. You're going to want to know how your business did from a sales perspective, day to day. Accounting records and reports help you run your business efficiently and profitably by keeping track of money earned and spent. Our financial statements can tell us how much we spend in order to acquire a client, can also help us understand if we're making profit or how much of something we need to sell. I know a lot of you guys are seniors and you're working with supply and demand. Well, supply and demand is about finding price equilibrium, but if the price has to go so low that we don't make a profit, then there may not be a point to being in business, and or we may need to sell something else. These are kinds of the decisions that we're able to look at and make with our numbers. So we're going to keep going. So here's that term GAAP, generally accepted accounting principles established to allow businesses to use the same system of recording and reporting financial information. So all businesses, large and small, use GAAP. Some businesses do basic accounting and then they turn all of their information over to CPAs who a couple times a year update all their documents. Larger businesses have accountants that are CPAs, and those CPAs understand and know GAAP and function in that manner. Mrs. Sable House next door teaches accounting, used to be a CPA. It is a licensed position that requires you to keep that license up to date on a regular basis. If you need me to stop, let me know. Otherwise, I'm going to keep going. So, formal definition for financial reports. These are the statements or documents that summarize the results of a business operation and provide a picture of its financial position. So, we write those statements in a GAAP format. And those financial reports are for things like bankers, buyers, owners, government agencies, and they even tell consumers how well your business is doing. So accounting is based on a number of assumptions, and in those assumptions, we kind of make a couple suggestions, and we just mentally have them in the back of our head. For example, we assume that a business is its own entity. It's its own thing. It has its own checking account. It is not tied to a person directly. We also assume that our financial reports cover a specific period of time, and that period of time is consistent year to year. So we assume that the balance sheet covers one point in time. I mean, literally one day. So what is the balance of my cash account on November 1st, 2020? On the other end, that income statement covers a period of time, and I missed period in time. Like 1 year, 1 month, 1 week. How much revenue did we have from, and then pick your choice. But that income statement covers more than the balance of the account on one day. It covers the revenue account as it goes up over the year. So get that down onto that last sheet, and we'll keep going in a minute. All right, so the accounting period is any block of time, month, quarter, or a year covered by an accounting covered by an accounting report, i.e. an income statement that covers a quarter, a month, or potentially a year, and then the balance sheet is the opposite of that. It is just one single point in time. We'll keep going unless you tell me to stop. So we kind of have two different ways of calculating time. We have a calendar year, which is January 1st to December 31st, and then we have a fiscal year. Calendar year being your kind of traditional year, and your fiscal year is the accounting period of time that begins and ends in months other than the calendar year. So the fiscal year might run from March 1st, it might start, and it might end on February 28th or 29th if it's a leap year. And some businesses choose to run this way because their January 1st is incredibly crazy busy. For example, retail stores tend not to have their fiscal year end in December and January. Why? If you're thinking about that time frame, December is when retail does most of their business. In fact, almost 75 to 80% of their business is done between November and December. So they don't have the time on January to kind of wrap up the year. January 1st through 5th, they're doing things like, people are using gift cards and doing returns. So fiscal year versus calendar year. So each business in accounting creates their own set of accounts, and they might name those accounts different or give them different numbers. However, they use the same concepts and procedures for recording, summarizing, and reporting financial information. This way, if we're the wealthy investor, we can compare apples to apples. If everyone did things differently, it would be really hard to make comparisons and decisions onto whether or not this is a good or a bad business. So, and it kind of looks like this. They might have accounts payable over here that they're constantly using to order, get inventory in, invoices, and write bank checks. And then accounts receivable over here where people are making payments and orders and they're sending out inventory. And all this stuff is going through their inventory accounting system. It is running everything, and all of this is similar. However, names might be different, and we'll get to that in just a second. So every a company has their accountants created what's called a chart of accounts, and that is the list of accounts a business uses in its operations. And they'll use them for their three categories on the balance sheet, and that's the three categories on the balance sheet are assets, liabilities, and owner's equities. And what this doesn't talk about is there's also two types of accounts on the income statement. That's revenue or expenses. So it's almost like there's 5 types of accounts, and we'll get into that in a bit. But this is kind of what your chart of accounts looks like. So your assets are your 100 accounts, and they go by cash is 110, notes receivable is 111, accounts receivable is 112, and all these accounts have different meanings. And we'll work on these individually in a little bit. We'll have a little assignment to do. But for now, just understand that this account, everyone's going to have a cash account, but not everyone has to have that account be called 110. It might be a different number. It might be 101 or 121, depending on how the company wants to function. So, cash or accrual. So, businesses have to decide whether they're going to use a calendar year or a fiscal year. They also have to decide whether or not they're going to run on a cash basis or accrual. And this is all about when you actually do transactions in your accounting system. So, on a cash basis, the system in which income is recorded when it is received and expenses are recorded when they are paid. So that is cash basis. That means when I order something, and say I run a business and I order a bunch of t-shirts, and I don't have to actually record in my accounting system that I ordered those t-shirts until I go and pay for them. Now that might be 30 to 45 days after I ordered them. That's the cash basis. I'm doing everything on when the cash changes hands. Most accounting or larger companies don't function like that. They use what's called an accrual basis of accounting. They record things when it's earned and when things are paid. So you're kind of matching, and they have this matching principle in accounting when you're doing things like income is earned. So if someone orders t-shirts for me, do I wait to get the money? Well, most of the time I say, hey, they're earned. This is when the revenue was earned. This is when the expenses occurred. I'm making them match up. There were expenses because, well, I had to do something to my t-shirts and print them and so on and ship them out. And so I had expenses oriented with that. Then maybe I had to order shirts. So there is a certain amount of expenses that are tied to that revenue coming in. And the best way to think about it is this is your kind of basic accounting cash basis. And then most companies use what's called accounts payable and accounts receivable, where things are done on credit, and we move to what's called accrual basis for more advanced and larger companies. So We might play a little game later on. It's kind of fun, but it's the debit and credit game. It's not exactly fair, though, for the few of you in here that have taken accounting and will do really well while others won't. But there's a set of rules that goes with accounting that says debits go up for these type of accounts and credits go up on these type of accounts. And it's to make our accounting equation balance. We're not going to probably go into that much depth where you have to know it, but it is kind of interesting. But know this with debits: additions to the left side of an account that increases the balance of all assets and expense accounts and decreases the balance of all liability and revenue accounts. You want to make sure you have that written down. And I'll wait a little bit so we get through this. Credits are the opposite, and that is they are additions to the right side of an account that decrease the balance for all assets and expense accounts and increase the balance for all liabilities and revenue accounts. And actually, Mr. Barron, show them an example of how this works, or calling someone that has accounting and have them show an example on the board of how this works. That's a better idea. Like maybe, well, don't say any names, so you use this for another year. But you know who you're talking about. All right, this would be a good spot to pause, and then we'll come back in a minute. This is what it looks like for all of these different statements. Assets go up on the debit side, and assets go down on the credit side. And then at the same time, liabilities go down on the debit side and up on the credit side. Down on equity on the debit side, up on credit, and then expenses and revenue. And we'll talk about those in a minute. So, businesses keep a journal of where everything occurs for each and every account. This is usually digital nowadays, where it's on a computer or on QuickBooks on some type of format or system that makes it easier to function and use all the accounts for your business. And that's a financial diary, is almost like a way of thinking of it. So your journal is the financial diary. Journalizing is the business keeping up to date on all of the transaction. So the process of recording business transactions, usually on a daily basis as they occur. The general journal is an all-purpose journal that's used to record all types of business transactions. And this is the most common type of journal that accounting systems use. And most simple small businesses, this is the only journal that they will have. As businesses get really big and there's a lot of accounts, your accounts receivable might have its own journal, or your sales journal might have its own journal, and it all depends on the size and scope of the business. So this is kind of what it looks like where we're marking various accounts. This is on 3/17. We'll call that January 7th, 2018. There's depreciation expense, and they're recording depreciation for July of 2018. Here you have inventory going up. So there was a purchase of inventory. It went up, and then cash went down. And this is just the way businesses record their entries. And at the same time, these amounts are impacting the various accounts. So your cash account will be going down $5,000, and inventory will be going up $5,000. So posting is the process of transferring amounts from the general journal in the general ledger. We're not going to do this in this class. You guys, if you go to accounting, that's kind of one of the things you do. You do a lot of posting. You do a lot of this stuff by hand, so you understand the process. And if you're actually going to be an accountant and get into it in college, this is just an awesome way to start, is in high school. So, and here's another example of general ledger preview. Sorry. So, and then it'll post the various, so here's your assets, and here's what debits happen to assets, contract assets, revenue, what happened to that account over the period of time. and how it changed. So the accounting equation is assets equals liabilities plus owner's equity. And I'm going to ask you this quite a bit, and it's going to be on the test. So make sure you know this part. But an asset is anything of a value that a business owns, such as cash, equipment, buildings. All those things are called assets. Assets are specifically for the balance sheet. So if you were going to write anything, make sure you understand that this is the balance sheet equation on our last note sheet. Make sure you get that there, as well as these are the 3 types of accounts on that financial statement. So if someone said, where does liabilities go on the income statement? They don't go there, okay? They go on the balance sheet. So give you a couple more seconds, then we'll go. All right. So here is an example of a balance sheet. And it starts off here, their assets and current assets, and we'll talk about current versus non-current assets in a minute. But so it starts out with cash and marketable securities are stocks and investments. Their accounts receivable is amount of money customers owe them. Inventory is what you think it is. It's inventory on hand. And then prepaid expenses are expenses that have already been paid in the future. We call that an asset because we don't have to pay them in the future. Non-current assets is known as property, plant, and equipment, and we record those at cost. What does that mean? If I bought a building 100 years ago, on my balance sheet, it will be recorded at the purchase price of that building. And then we'll do what's called depreciate that building. And we don't have to go into that now, so I'm not going to, that's a whole mess of an explanation that I'm not going to worry about right now. Other investments, patents, and trademarks, we talked about that. Goodwill is another long story we're not going to worry about at this point in time. We're going to skip over to current liabilities. Accounts payable is money we owe usually to suppliers. Bank loan payable is exactly what it sounds. It's the amount we owe to the bank this year. And then our accrued liabilities can be from various sources. Taxes payable is taxes we owe this year. And then the current portion of long-term debt. We might have long-term debt to a prior owner or someone we have a contract to, and we move a portion of the long-term debt into the current portion. Because current means something that's due within the next 12 months, whereas non-current is due in the years in the future. So we're taking the loan, and in this loan it looks like that they're paying, call it $500 of this $2,000 loan. So at some point last year it was $2,500, right? We're paying $500 off, and then in 4 years it'll be paid down to zero. And then owner's equity is the equity we have in a business. We'll do some assets equals liabilities plus owner's equity equations and some examples later on. But an equity is what's owned in the business that does not have a liability on it. So if you think about it, we'll take all of the assets here, and this should be equal to the owner's equity plus the total liabilities. Okay, so formal definition of a balance sheet, and get this on your last sheet. Report of the final balances of all assets, liabilities, and owner equity counts at the end of an accounting period. That's too fast, I'm sure. So I give you 10 more seconds to get that down. Okay, so current asset is cash or any other items that can be converted to cash quickly and used by a business within a year. That's my 12-month period. Those are all current assets. Accounts receivable is the amount customers owe a business. Fixed assets is any items that will be held by a business for more than 1 year. Equipment, trucks, or buildings. These are non-current assets. They'll be held and are not as easily turned into cash. What does it mean for an asset or liability to be current? Current refers to a specific time period. How long do you think it is? I already said it, so hopefully you know at this point. Hopefully you're guessing right now and saying it out loud. All right, let's keep going. The accounting equation, we're almost there. Total assets minus total liabilities, which includes accounts payables, equals the owner's equity. So this is an algebraic formula that is easy to manipulate. It only has 3 parts, and here is another way to look at it. Assets minus liabilities needs to equal owner's equities, or we say assets equals liabilities plus owner's equity. Accounts payable is the amount businesses owe to creditors. Creditors might be suppliers or usually suppliers of some form of service to the business. And owner's equity is the worth of the business. Here's your equation really big. Make sure you write that. Should be on your balance sheet already. Make sure it's there. Okay. So on the regular daily, businesses prepare cash receipts, cash on hand, and sales. And that is our last section for today.